Welcome to part 4 of chapter 9. We're going to be looking at accounting periods and methods in this chapter, as well as a few other things, but that's our principal focus here. So generally, taxpayers will report income and deductions over a 12-month period. We already know that. And for most taxpayers, they're going to use a 12/31 year end. That's the most common for individual taxpayers. However, it is also possible that a taxpayer might choose a fiscal year, and so they might have a month that ends other than December. Maybe it would be June 30th. Alternatively, taxpayers are allowed a 52-53 type week where they have it ending on the same day of the week every year. So they might want to have a Friday cutoff or something of that nature as opposed to a floating ending day, since December 31st does not always occur on the same day of the week every year. It's also possible for a short period when you're making a change. So if you're going from a calendar year, let's say you had a 12/31 year end, and you want to move that to a 6/30 year end, well, you're going to have that short period. And then from there on, you'd be on a year, 12-month period. But there would be that short period that might occur when you have that change. This slide illustrates the fact that flow-through entities do not actually have all types of years available to them. They really have to look at their owners in determining what their year end should be. So if you have a sole proprietorship, you're normally going to find that that's a 12/31 year end because the individual's tax return is probably using a 12/31 year end. So that's certainly the most common. Partnerships are going to look to the partners to determine what's the most common year end among those partners. So if you had a partnership with a lot of C corporations that had maybe a 6/30 year end, then it would be possible that the partnership might have a 6/30 year end. However, most instances the partnerships will have individual members, and so you're going to find a 12/31 is the most common year end for partnerships. The same for S corps. You look at who owns that S corp to determine what's the appropriate year end for the S corp. LLCs follow those rules. If an LLC is treated as a partnership, then it would have to follow the partnership rules with respect to adopting a year end. Likewise, if it's treated as an S corp, it would follow the S rules. And if it's a single member LLC, then it's treated as a sole proprietorship. So really an LLC has the ability to be a lot of different entities, and you just would use the year end that's appropriate for that type of entity. Now, in terms of the methods that are used, we can use any method as long as it clearly reflects income. So the cash method, the accrual method, or anything that's a hybrid is also allowed for tax purposes. Most of the taxpayers you would probably encounter will use the accrual method, and that's the method that we'll spend most of our time on. It's also the one you're most comfortable with. But be aware that many small businesses are still using cash method, or something in between. They might have inventory correctly accounted for on accrual, but they might use cash for other things. In terms of adopting the cash method, you're allowed to adopt the cash method. There are some exceptions, however. If you have a lot of inventory, if you have a large amount of inventory, then you're going to have to use accrual method. Also, when you're buying long-lived assets, you're going to have to capitalize it. So even if you're a cash basis taxpayer and you go out and you buy a $100,000 piece of equipment, you're going to have to capitalize it and recover the cost. So you're essentially on accrual whether you like it or not. And then with respect to certain prepaid items, if you prepay insurance, rents, and services, you can deduct those currently if the prepayment period is 1 year or less. So we're looking at 12 months or less. So if you're paying in advance, that's only going to be for 12 months or less, then you can go ahead and deduct that currently. In addition, you also have a 12-month rule, which is basically saying that the prepayment period cannot extend beyond the end of the tax year. So this is more about the timing of when the payment's made. When does that period start, and is it outside the year end? So this might be the current year end. We make a payment here in December, and then and that's 2017, and we have 2018 is the succeeding tax year. And maybe that payment is actually only going to be good for stuff that takes place into 2019. If that's the case, then we would have failed that second test. The 12-month rule would have been failed, and we would not have been allowed to deduct it currently. Some other points, we mentioned points earlier when we were discussing interest on homes. If points are incurred for anything other than a principal residence, they would have to be capitalized and then amortized over the loan period. Credit purchases, you're generally going to deduct them when they're made on your charge card because you're liable. It's like a loan. If you drop something in the mailbox, you deduct it when it's actually dropped in the mailbox, even though you know it's not going to be delivered right away. And in terms of the accrual method, which again is more taxpayers are using the accrual method than cash, there are two tests that have to be satisfied to get a deduction under the accrual method. So let's spend a little bit of time on this. The all events test we saw before with respect to income recognition. And so it's the same test, just now it's applied to expenses. And so it's basically we're looking at the liability has to be fixed and it has to be determined with reasonable. So it has to be fixed and determinable is really what we're looking at. Those are, my pen always stops when I want it to. But you have to have a fixed and determinable type of expense before it would meet the all events test, just like with revenue. It had to be fixed and determinable. So the same two prongs are going to apply here. In addition, expenses, because the Internal Revenue Code and Congress really want to kind of postpone deductions as much as possible. They have an economic performance test that also has to be satisfied. So there's essentially an extra test that wasn't present with respect to revenue recognition here. That's why I indicate 1 + 1 = 3, because essentially there's three tests here for expenses. It has to be fixed, it has to be determinable, and it has to be meeting the economic performance test. So let's actually look at what that economic performance test is about. Okay, so let's take a closer look at economic performance. Economic performance breaks down into a number of transactions. And so you're thinking about the taxpayer, and the taxpayer wants to claim a deduction. And you're asking yourself, has the taxpayer paid for this yet? Or is it something that's just potentially going to be paid for in the future? And what is it that the taxpayer is actually getting? So you have to kind of analyze this from a multidimensional perspective. So first of all, if the taxpayer is receiving goods or services from another, so in other words, there's a contract with some other party, and they're going to be shipping services and something or goods they're going to be providing services or shipping goods to the taxpayer. Then basically, if it's paid on or after the receipt of those services or goods, we would deduct it when it's received. So this is very much the accrual idea, right? We've got a contract with another party, and we are now liable for that, and we then will have to pay irrespective. So once we receive that, then we definitely have to make payment, right? Whether we make it right then or later, we would get the deduction when we receive it. If it's something that's prepaid, so in this instance, we essentially are paying for this in advance, right? So prepaid. So now I have the taxpayer who is essentially paying something and hasn't received any of the services yet. So now we're actually going to look at a 3.5 month rule. And it's, are we going to receive this from the other party within 3.5 months after payment? So we make payment on August. That's not good because it's going to fall within the same year. Let me actually pick a better date. We make payment here in November, so that we're actually only going to be receiving it maybe in January of the next year. Then the question is, well, do we deduct it in the 2017 tax year or do we deduct it in the 2018 tax year? And if we have the 3.5 month rule, then apply that we expect we're going to receive it, we should receive it in the next tax year, and it's within 3.5 months after we make this payment, then we're good. We can go ahead and we could deduct it in the 2017 tax year. The next rule is with respect to providing goods or services, and now we just would deduct it as we're providing. So now we're going to expend costs in providing services or goods, so we can deduct as we're providing those. Now we're actually in this next, we're thinking about we're using somebody's property, so we're maybe renting, or we're using some sort of copyrights, or some sort of patented things, so a variety of aspects that we could be actually using someone else's property or their goods. And now we would deduct it as we use it. So it's more of an idea of usage. So we track our usage and deduct it as usage, kind of prorated it. Interest in rent is on per day basis, right? So we wouldn't have to actually clock in how much of the item we used per day. We would just ratably deduct the use of the cost for the use of that property or the money that we've borrowed. Then there's such a thing as payment liabilities. These are rebates, warranty costs, tort claims, and taxes, as well as a host of some other things that fit in that category. And these are deductible only when they're paid. So if we're actually selling merchandise and we offer our customers a rebate, then we have to wait till they submit the rebate claim, and then when we make that payment, we would get the deduction. Recurring item exception is an important exception here. Notice it doesn't apply to the tort liabilities that we just mentioned on the other slide. First of all, the liability has to be expected to persist into the future. It cannot be material, or alternatively, a current deduction would result in a better matching. We all understand the matching principle. And then this is real important in here. The economic performance occurs within 8.5 months of year end. A little different. Remember, the 3.5 month rule was at the payment date. We were looking at 3.5 months within the payment date. Here we're actually looking at year end. So we're December 31st. Economic performance is then going to occur within 8.5 months. So somewhere around, let's see, that would be September 15th, I think. 8.5 months of the year end, we'd actually have to receive the economic, whatever it is we bought or whatever sorts of items we're receiving. All right, this is a case actually that has facts going back to 1972. And I'm going to apologize. This is actually the 4th time I've had to record this because of my equipment. So my explanations hopefully will get through this time. The Supreme Court case, 1987, again going back to 1972. And so we have General Dynamics, which decides it's going to adopt a self-insured plan. And so it essentially in 1972 has its employees where they will go off and see the doctor. And they will actually pay the doctor. And then they'll ask General Dynamics to reimburse them for that cost, okay? So it's just a reimbursed self-insured type of plan where employee goes to the doctor, pays doctor, General Dynamics then reimburses employee. And we have actually, at the end of 1972, we have some employees who have actually gone to the doctor but have not yet submitted claims for reimbursement. And then later in 1973, General Dynamics does receive those reimbursement requests and pays the employees for the medical care. The question that really arises here is, can General Dynamics claim a deduction for the cost of the medical care that's reimbursed in early 1973, but it actually relates back to care that was received in 72? And the Supreme Court looked at this and essentially said, well, wait a minute, there's some uncertainty with respect to the dollar amount. If you actually just stop in time here at the end of 1972, do you really know that the cost is fixed and determinable? In other words, have we satisfied our all events test? Is the dollar amount actually fixed? Because on December 31st, do you truly know that all these employees are going to submit reimbursement requests? And in fact, because you did not, the Supreme Court disallowed that deduction and basically said you cannot claim deductions for costs that may not be incurred with absolute certainty when you don't know for a fact that these employees will submit requests for reimbursements. This contrasts to a revenue ruling which actually dealt with a manufacturer who offered their retailers an incentive program. So at the end of the year, around the months of October and November, the retailers were asked to go out and put out some advertising to sell this particular item, which I believe is Campbell's soup, something of that nature. Although again, it's a revenue ruling, we don't know for sure. But there was some sort of a push to sell this manufacturer's products. And so the retailers started all this advertising with the full understanding that they would essentially be reimbursed for that cost or part of that cost by the manufacturer. And they had essentially 90 days to submit the request for reimbursement of the advertising. So some of the advertising costs actually then were paid in the following year by the manufacturer. So we essentially have the advertising occurring here in the earlier year, but there's a repayment or reimbursement to the retailers that actually occurs in the following year. And again, the question before this ruling, what the IRS was attempting to address, is could the repayments in the second year actually be deductible in the earlier year when the advertising occurred? The answer is yes, and that might seem in stark contrast to General Dynamics, but if you look at the reasoning to the ruling, it actually makes a lot of sense. In this instance, we're dealing with retailers. Retailers requesting reimbursement for advertising costs. Is the amount that the retailers are going to request fixed and determinable is what we're asked. And because we're dealing with retailers who are in business to make money, it's absolutely certain they're going to request reimbursement for that advertising. It's not the same as an employee who might or might not ask for medical reimbursement. An employee often forgets. It's like those rebates on stuff you go out and you buy in the store. Sometimes you do submit them, sometimes you don't. So there's not absolute certainty here with the employee asking for their reimbursement of their medical. When you're dealing with a retailer, there was absolute certainty that they would ask for a reimbursement. And so the deduction was allowed in the year the advertising has occurred, even though it was only paid by the manufacturer in the subsequent year. This highlights really the code sections that are relevant for different types of deductions. And if you ever get into this area, it's a really interesting area. So some costs have to be capitalized, some you're allowed to deduct, and some are simply disallowed, like meals. We know that 50% of meals and entertainment is disallowed, as well as a variety of other types of costs. A couple of examples here. We have an accrual method taxpayer who signs a binding contract to provide repair services. They pay for the services up front, and then they agree they're going to pay an additional amount when the repairs are completed. So they put a partial down payment on the services. The repairs actually will start in the fall of the next year. Okay, so they're actually not going to occur. We make the payment here, the down payment, but we're actually going to pay for the full services in 2018. And the answer is we're not going to get a deduction here because we haven't actually prepaid entirely, and in fact we would have had to have done so. So I think the answer here, it doesn't really show up because I just wrote over it, but they could deduct the 7.5 in the year when they actually have the repairs completed. Now we have November and December. XYZ provides installation services to ABC for an agreed price of $50,000. At the end of the year, XYZ has not yet billed. That's not really good business practice, but they haven't been paid yet because they haven't billed. Can they go ahead and claim the deduction for the cost of actually providing the services? And the answer is yes. They've actually incurred that cost, and it's absolutely certain that they will eventually bill. So they would be entitled to a deduction in the current year. Same facts, except now we're asking, what about ABC? They haven't received the invoice yet. They've received the services, but they haven't received the invoice. They would be entitled to deduct the cost as well, $50,000 in the current year. They're receiving services from another, and economic performance has already occurred. Now we have a situation where ABC enters into a snow removal contract. So they basically are going to get the snow removed in X2 through March, so January through March 15th, that date is kind of important, of X2, and they're actually going to make payment here on December 15th. So we're prepaying for services. You want to go back and look at the slides that talk about prepayment for services. You're going to notice if you prepay, you actually have to get the services within 3.5 months, have to be complete of that payment date. So we're looking here at 3 months, we're good. We could go ahead and claim a deduction then in the earlier year. And hopefully that's what this answer is going to state. That, yeah, we're going to get a deduction. 3.5 month rule is satisfied, we could claim the full deduction in the earlier year. Now we've got some problems at the end of the chapter. So we've got Justin, who paid $4,008 for an insurance policy on his business. He's a cash method taxpayer, and the policy is going to go from April of that year through March of the first year. So we have a cash basis taxpayer. He's going to satisfy our 12-month rule. The insurance is not going to extend beyond 12 months. He's paid it right now, so he would get the full deduction for the insurance. Now we're told that the policy actually is going to begin in year 1 and it's going to extend into year 2. So we're going to fail the 12-month rule because it's going to extend beyond the end of the next year. It is a 12-month contract, but it is beyond the end of the next year, so no deduction. Now we're paying $6,000 for a 2-year policy. We're going to find that we would prorate that because some of it will actually fall within that period. So we could go ahead and we could prorate the insurance. And in this instance, we've got 9 months in the current year over the total that he could go ahead and deduct $2,550. Now, instead of paying for insurance, he's actually going to pay for rent. And it's going to go from April through March 31st. That doesn't change the answer. He would still get the deduction here. We really haven't changed much. He had insurance before, now he has rent. We didn't do interest, so we really don't see any major change. Then I have this one with respect to Circuit Corporation, their accrual method. They sell electrical components, and they basically have a $100,000 contract, and it's actually going to spread out for 5 years. So in this instance, we're going to prorate it over that 5-year period. They're going to be entitled to $20,000 each period because we're using property of someone else. We have some exclusive rights to this thing, and we're using property for someone else over a 5-year. We're going to ratably spread it. So hopefully that's what the answer says. Yeah. So when the contract begins and we're actually starting to get some use out of the exclusive rights, then we would start deducting $20,000 over the 5 years. Now we have Elizabeth, who agreed to a 3-year contract for some improvement to her factory. She will pay consulting firm $1,500 for each time she requires their assistance. However, she only has to pay if after a 12-month period they can measure some improvement in her efficiency. So there's a contingency here. Her payment is contingent on the fact that they actually help her. How much should she deduct if she uses the accrual method? Well, if she's using the accrual method and she's called for service 3 times, we don't yet know that they've actually improved her efficiency, so we actually don't know that the amount is fixed and determinable. So as a result, she wouldn't get any deduction right now. If she's using the cash method, it's quite clear she hasn't made payment yet, so there would be no deduction allowed. With respect to inventories, you're already familiar with how to account for inventories, and we will normally use the accrual method for inventories as long as it's material. We do have a couple instances where you would claim that the inventory is not material, less than $1 million or gross receipts less than $10 million. Normally you still would find that accrual works a lot better, but that would be the dollar limitations for when the taxpayer must absolutely use accrual methods for their inventories. The UNICAP rule is essentially a capitalization rule that states that you have to capitalize a lot of costs into your inventory. It's a little bit different than financial accounting capitalization. So we tend to capitalize more costs into inventory for tax purposes than for financial. You're already familiar with the different methods, first in, first out, LIFO, and specific identification. Be aware that a LIFO method, because it tends to reduce taxable income, is not one that is favored by the IRS, and so the taxpayer must actually have book tax conformity. So for financial purposes, they also have to use the LIFO method. Bad debts. Bad debts arise with the taxpayer's trade or business, and they must be business related. Otherwise, they would be treated as a personal bad debt. A business bad debt is deductible when it is incurred. You can get a deduction unlimited for the full amount of the debt, as long as you have basis in that debt. And you could also start a deduction for partial worthlessness. So it's very different than a non-business bad debt. A non-business bad debt is one that is simply not business. So it's among friends or family, or it's an investment. The biggest thing is people think investment loans are business. They're not business loans. They're non-business. The treatment here is not nearly as favorable. First of all, there's treatment is short-term capital loss, which means you have a $3,000 annual deduction. So if someone has a $100,000 business loss, then they can go ahead and deduct that fully. But if it happens out to be non-business, they're going to be capped at $3,000 each year. So it's going to take a long time to get that deduction. Also, there's no deduction allowed for partial worthless, so you have to wait until you have a final absolute number that you know you could deduct. You also have to look to basis. Irrespective of whether it's a business or non-business bad debt, you cannot deduct something that exceeds the taxpayer's basis in the debt. And that brings up the issue here with respect to receivables. To the extent you're a cash basis taxpayer, you are not likely to have a basis in a debt that's a receivable. So you sell merchandise to a customer and you have an account receivable they're going to owe you later, and they don't. Well, you can't take a deduction for that because in fact you never recognize the income from the sale. So there's no basis in the debt. On the other hand, if you're an accrual basis taxpayer, you sell someone merchandise, you're going to actually recognize sales income. So there's going to be something that's taxable at that point in time. Later, when they fail to repay, you would get an offsetting deduction. So you're back to not actually, so essentially it offsets the income and you're back to zero. Just like the cash basis taxpayer never recognized any income. As a result, he doesn't get a deduction when it fails to be repaid. So aspect of basis is important. Loans, you'll always have basis, so it's not really an issue. In terms of the timing on the deductions, accrual basis taxpayers use the direct write-off method for bad debts. So we're actually looking at, you have to specifically know which loans have gone bad. You can't just make some sort of estimates off of that. Okay, and that's a little different than financial accounting, so we're going to have some timing differences that will originate because financial, as you recall, uses that allowance for bad debts technique. So XYZ estimates about $1,000 of receivables from its plumbing services will be uncollectible. Included in that is $300 specifically. This is the estimate. That's the specific. So 1,000 is an estimate, 300 is specific. What amount can they deduct if they're on the cash method? And they would be entitled to a deduction on the cash method of 0, right? Because they never recognized any income from the services. If they're on the accrual method, they would get a deduction of the $300 that they could specifically identify. So hopefully that's what it says. There's no basis. If they're on the cash method, no deduction. Accrual, they would have the $300. This is something I want to illustrate just if you were to be given this sort of a fact problem, and sometimes they do. On the CPA exam, or I might give it to you on an exam. You might be told the beginning balance and the allowance for doubtful accounts that the taxpayers also had a certain amount of bad debt expense that they've incurred during the period, as well as the ending balance. So you might be given these three numbers, and of course you know from your T account analysis that you could calculate the amount that was the specific write-off for accounts receivable. This is the actual amount that would be allowed as a deduction. Not these other amounts, okay? We've got a change in the balance, and we know that there's been some estimate, but we're actually trying to identify what was the specific loss that was identifiable and written off. That's deductible. So kind of think about this in terms of the journal entries. And I know we don't do journal entries in this class, but that $20,000 allowance amount was actually a credit to the account receivable. That's the component we really are interested in. What happened to the account receivable itself vis-a-vis the allowance for doubtful accounts? Okay, so that's what we're looking at. The write-off here is the $20,000. Okay, now this slide is trying to discuss some of the limitations when you're dealing with related parties, and one of them's an accrual basis taxpayer and one of them's cash. We'll say they both have a 12/31 year end. And the accrual basis taxpayer, we'll say, is a corporation, and it decides it wants to pay a bonus to a cash basis employee owner, because it has to be related. We'll get into related in another chapter, but an owner of a company would be related. Wants to pay a bonus, but actually just because it's accrual, it's just going to accrue it. So it just declares the bonus. It doesn't actually pay it. So that's in 2017, it makes that declaration. And then in 2018, it goes ahead and it pays the bonus. So there's payment that occurs in 2018. You might think, oh, accrual basis taxpayer satisfied the rule, the economic performance is occurring, we're paying services, etc., etc. We should be entitled to a deduction in 2017 when we accrue the expense. The answer is no, because it's only picked up in income by the cash basis taxpayer in 2018, and there has to be symmetric treatment when you're dealing with these related taxpayers. So that's what this rule is really getting at. If you've got related parties, one of them's cash, one of them's accrual, you're only going to actually be allowed a deduction when it's picked up in income by the cash basis taxpayer. So 2018. In terms of adopting methods, there are permissible methods and there are impermissible. You can adopt any method you like. If you're permissible, you're fine. You've established that after the first year of use. Impermissible methods you have to use for 2 consecutive years, and then you have to stay with it. If you want to change from an impermissible method, you need the IRS's approval, which they're easy to get. Is easy to get. I don't want to scare you in that sense. They do definitely allow for changes to permissible methods. That concludes this part 4 and the end of chapter 9. Thanks for listening.